All right, folks, the Bank of Canada cut interest rates by 1/4%, as was expected by many. What the Bank of Canada said is actually the more important part, not what they did. So they highlighted two main things for their reasons for cutting rates. One of them was the continued easing of inflationary pressures in line with expectations. And the other thing was that they see economic weakness prevailing in the months ahead. And those two things combined will continue to see inflation go downwards from here. Now, the one component of inflation that is still remaining high and stubborn is the shelter price. But if you think about shelter, the pricing pressures from shelter has been mainly driven by immigration, and the federal government has made some major decisions and changes lately to immigration in Canada, and we're already starting to see those changes have an impact on real estate, specifically in university towns, where there's starting to be an increase in vacancy in university housing, student housing. And I expect those changes to continue going forward. And so that should have a lasting impact on shelter inflation in the months and years ahead. So the lagging indicator in inflation pressure is shelter, but shelter inflation will be coming down because of the changes to immigration lately. So looking out a year from now, inflation is going to be lower, much lower. And I think the Bank of Canada is going to be more concerned about downside inflation, turning into deflation. And they even alluded to this in their comments today, that there's two sides to it. One is they need to see inflation come down, but they don't want to see inflation turn into deflation. And so at the same time, they need to stimulate the economy as inflation is approaching their target of 2%. So if they believe that downwards momentum in inflation is actually picking up and is getting too fast, they're going to start to cut more aggressively in the months ahead, if that is the case. It's not right now, but just so you're aware that if inflation starts to ease faster than they expected, they may have to cut by 0.5% a few times over the next year, which would make interest rates fall towards the neutral rate of 2.5% quite quickly. I believe we're going to be at about 2 to 2.5% by this time next year in interest rates. So, we could see the 5-year fixed mortgage rate around 3%. We could see variable rates about 2% lower than where they are, maybe 2.5% lower, which would get you down to around 4%. So mortgage rates are heading in the right direction for mortgage holders. This is all great news for the real estate market and for people that are finding it very tight to manage a balanced budget these days. All right, everyone, have a great day. Take care.